Critical Men Pictures presents the Forex video training series. Orange Belt, Introduction to Fibonacci. Fibonacci ratios are used a lot in Forex training, so you had better learn it and be able to apply it. One helpful piece is that most of your charting packages and trading platforms have Fibonacci extensions and retracements as a tool, so you can just let the program do all the complicated math. Leonardo Fibonacci, an Italian mathematician, discovered that a simple series of numbers created ratios describing the natural proportions of things in the universe. The numbers arise from the following number series: 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, and so on. The series of numbers is derived by starting with 1 followed by 2, adding 1 and 2 to get 3, then adding 2 and 3 to get 5, and so on. After the first few numbers in the sequence, if you measure the ratio of any numbers to the succeeding number, you get 0.618. For example, 34 divided by 55 equals 0.618. If you measure the ratio between alternate numbers, you get 0.382. For example, 34 divided by 89 equals 0.382. And that's about as far into the explanation for the nasty math as we'll go. The ratios are the golden mean. These are the ratios you must learn. Fibonacci retracement, 0.236, 0.382, 0.5, 0.618, 0.764. And the Fibonacci extensions that you must learn: 0, 0.382, 0.618, 1.0, 1.618. Traders use Fibonacci as potential support and resistance areas. Again, since so many traders use Fibonacci, this tool tends to become self-fulfilling. The main thing that one should learn about Fibonacci retracement tools is that it works best when the market is trending. The idea is to go long, buy, on a retracement at a Fibonacci support level when the market is trending up, and go short, sell on a Fibonacci resistance level when the market is trending down. In order to find these retracement levels, you have to find the recent significant swing highs and swing lows. Then for downtrends, click on the swing high and drag the cursor to the most recent swing low. Let's take a look at some examples on how to apply Fibonacci retracement levels in the markets. Uptrend. Here the Fibonacci levels were plotted by clicking on the swing low and dragging the cursor to the swing high. The software magically shows you the retracement levels. Now, the expectation is that if the euro-dollar retraces from its recent high, it will find support at one of the Fibonacci levels, because traders placing buy orders at these levels as the price pulls back. We take a look at what happened after the swing high occurred. Price pushed back to and past the 38.2% level, but was unable to close below the 50% level. Later on, the market resumed its upward move and eventually broke through the swing high. Clearly, buying at the 50% Fibonacci level would have been a profitable long-term trade. Now we'll see how to use Fibonacci retracement during a downtrend. The expectation for the downtrend is that if price retraces upwards from the low, it will encounter resistance at one of the Fibonacci levels because traders will be ready with their sell orders to jump into the market at a cheaper price. Let's take a look what happened. The market tested the 38.2% level, but immediately resumed the downtrend for several weeks. As you can see from the chart, if you would have placed a short order at 38.2% Fibonacci, you would have made quite a few pips. In these two examples, we see that price found some temporary support or resistance at Fibonacci retracement levels. Because all of the people who use the Fibonacci tools, these levels became self-fulfilling support and resistance levels. One thing you should take note of is that price won't always bounce from these levels. They should be looked at as areas of interest, not hard and fast numbers that must be adhered to. For now, there's something you should always remember about using the Fibonacci tool, that they are not always simple to use. If they were that simple, traders would always place their orders at fib levels and the markets would trend forever. Earlier, we looked at the support and resistance levels eventually break. Seeing how Fibonacci levels are used to find support and resistance levels, this lesson also applies to Fibonacci. Let's go through an example when the Fibonacci retracement tool fails. Here is a one-day chart of the Euro-US dollar. Here you can see the pair has been in quite an uptrend, so decide to take out your Fibonacci tool to help you spot a good entry point. You spot the swing high at 1.5890 and the swing low at 1.4420. You see that the pair has hit a shooting star candle and decide that a retracement will happen. If you really did put an order on your account, it would have taken a serious hit if you didn't manage your risk properly. Let's take a look what happened. Turns out the swing low was a foreshadowing point, and the market began to stall near the swing high point, which is also near a major psychological level of 1.60000. During May of 2009, and again during June of 2009, the price tested the 0.382 Fibonacci level, but around August 15th of 2009, the pair began to decline rapidly, and by September the pair had lost 2,000 pips. Yikes! What's the lesson here? When Fibonacci levels give you a higher probability of success, like other technical tools, they don't always work. You don't know if the price will reverse to the 38.2% level before resuming the trend. Sometimes it may hit the 50% or 61.8% levels before turning around. Sometimes the price will just ignore Fibonacci altogether and blow past all the levels with sheer force. Remember, the market will not always resume its uptrend after finding temporary support and resistance, but instead go past the recent swing high or swing low. Another common problem in using the Fibonacci tool is determining which swing low and swing high to use. People look at charts differently, look at different time frames, and have their own fundamental biases on what the market is doing. The bottom line is that there is no absolutely right way to do it, especially when the trend on the chart isn't too clear. Sometimes it becomes a guessing game. That's why you need to hone your skills and combine the Fibonacci tool with other tools in order to give you a higher probability of success. The next Fibonacci tool will be using Fibonacci to take profits. The key to trading in Forex is remembering to always have a way out. Let's start with a downtrend. Your general idea is to take profits on a short trade at Fibonacci price extension levels. You determine the Fibonacci extension levels by using 3 mouse clicks. First, click on a significant swing low, then drag your cursor to the most recent swing high, and then finally drag your cursor back down and click on any of the retracement levels. This will display each of the price extension levels, showing both the ratio and the corresponding price. As you can see from example, the fib levels would have been a wonderful project to take profits from the trades. This example illustrates that price finds some temporary support at the resistance levels, at the Fibonacci extension levels, but not always, but enough to correctly adjust your position to take profits and manage your risk. Of course, there are some problems to deal with here. First, there is no way to know which exact Fibonacci extension level will provide support or resistance. Any of these levels may or may not act as support and resistance. Another problem is determining which swing low and swing high to start from in creating the Fibonacci extension level. You will have to use your discretion in using the Fibonacci extension tool. You'll have to judge how much longer the trend will continue. Later on, we will teach you methods to help you determine the strength of the trend.